First, we had a big drawdown today. I want to talk about the drawdown. It's mainly driven by oil and the Russia crisis in the Ukraine. I also want to talk about more of a personal thing. I don't talk enough about business issues in terms of, like, let's say, what happens when you're not appreciated by your boss or by your customer, and you're trying to do your best, but you're not being appreciated, and how to deal with that. Those are typical practical business issues that do affect us here in the hedge fund business, because as hedge fund managers, we're not just putting money into business, we're giving entrepreneurs capital so they can build new worlds. And entrepreneurs are people, and there's a lot of interpersonal problems that sometimes occur. So these are important issues that I want to discuss today. This is a Not Even Wrong podcast. It's February 11th, 2022. This is Krim Delco. For the day, the fund is down 4.5%. The market's down 1.8%. For the year, we are down 22.2%. The market is down 7.3%. We're underperforming by 14.9%. We had a large drawdown today, like the market. The Nasdaq was down 3%, the S&P 1.8%, and we also were down 4.5%. And this is not driven by inflation. This is not driven by interest rates. It has nothing to do with that. This is purely the risk of Russia invading the Ukraine. Today, oil was up almost 5%. The defense stocks were up, and interest rates actually came down. The rates came down. So this is not an inflation situation. This is risk of war, risk of high energy prices, which of course will lead to a recession in the United States, like it always does. Even today, with less energy consumption, we're still exposed to that. So I just wanted to say that this is one of those situations where everybody talks about the wrong thing. Yes, one of the Fed governors, Bullard, talked about raising rates faster, and this was part of the reason why we had a sell-off yesterday. But today is real, mainly Russia risk. And I think the Russia risk is being priced in the market a lot more than we think. What is the risk with Russia? Well, we have first and foremost a war, which is always bad. We have an energy crisis in Europe through cutting off of pipelines and supply and all kinds of things. And then, of course, repercussions that we don't even know. We don't know what the unknowns are in any kind of conflict. We have a relatively weak White House with weak leadership, very basically no base here in the U.S. constituency-wise other than the hardcore unions and the woke type people. I guess at this point, nobody really supports the White House anymore and the Democrats. So I think that the people in power in the United States have very weak footing. They're very similar to the 1970s when Russia invaded Afghanistan with a very weak White House back then. Also, of course, it's very dangerous to argue by analogy, but then history really rhymes really nicely here. Let's say it that way. So it's not very good, doesn't look very good. I think we did say we do expect a recession for other reasons. This is another risk added to the whole recession conversation. And certainly we have to even more reason not to expect a slowdown in the next quarter or two. Like we said, we are comfortable with Tesla as a company. We're comfortable with our leverage. This is really what matters the most in situations like that. Volatility is part of the game. We've said that many times, and we're not going to try to trade around it. What we need to understand is why it's happening, and then also not lose our heads and stay focused on the mission, which is to generate wealth by investing in fundamentally new concepts and engineering practices. Now I want to switch to the second topic of today, which is something more personal, more sort of interpersonal. I would say put it in the realm of when the hard things are hard to do, a la Ben Horowitz in his book. I think what I want to say here is the following. When you work very hard on certain goals, when you manifest those goals by expressing them, I want to get there. I want to become a professional hedge fund manager. I want to manage a lot of money. I want to generate wealth. Or I want to be a successful professional athlete, or I want to be a successful professional artist. When you do these manifestations, first and foremost, it's very hard to do. It's very hard to say that to people, because I think we have this sort of modesty, ingrained in us to not say it, but wanting it. And I think just by saying it and imagining it and picturing it, that's already a big advantage. And then there's a risk to that. And the risk is that we then, by manifesting, let's say you want to be a professional athlete, you want to really work hard to become the best in your field. You do train a lot, and you will very often not get recognition. This happened to me on Wall Street. When I was on Wall Street, I was working 16-hour days, really hard, focused on making money, made money, and I got very little appreciation from my superiors. I got very little appreciation from my peers. I felt jealousy. I even felt some sort of mistrust and almost negative energy from coming out from my environment, because again, people were jealous. People weren't comfortable with the way I was making money because it was unique, it was different. This is a period that every 0 to 1 type person goes through in their lives. I have no doubt about that. And I think that's why I'm mentioning it here in our podcast, because 0 to 1 is one of the books that our principle stack is built on. And it's very easy to say you want to invest in unique people, and you want to invest in people that have a very different worldview and execute and work hard and all that stuff. But when the rubber meets the road, when people actually do it, they often get opposition. And when that happens, I think you start getting anxious. Anxiety kicks in. What am I doing? Why am I doing this? Why am I not being appreciated? I want to run away. I don't want this. I don't like this. These are typical, normal human reactions. Now, I'm not here to tell people what to do. I'm not a Dr. Phil or a psychologist. I can only tell for myself, speak for myself, how we deal with this, how I dealt with this in my career, how we deal with this. We even deal with this on a daily basis as investors. Of course, typical example would be you're invested in Tesla. Tesla is down. People say, well, there's competition. There's this, there's that. They have recalls. They have this, there's that. Electric's full of articles how Tesla is missing here and recalling there, and Ford is coming and the competition is coming. So there's all these tidbits out there that make you feared and sometimes make you look foolish. And I think, again, I'm not Dr. Phil. I'm not going to tell people what to do. I can just tell you what I do for myself, and that is scenario planning. So you sit down and you think about, okay, what are the scenarios here? What's the worst case? Let's take a simpler example. You're a professional athlete. You play in a soccer team. You train hard. You are appreciated by your teammates. You're appreciated by the club, but you're not appreciated by the coach. Let's say that's the scenario. Very difficult scenario. And you're not getting the kind of appreciation that often comes. Let's say the person doesn't talk to you. The person doesn't recognize you as an elite athlete working hard, but they recognize you more like an average person. They even make you feel average. How to deal with that? Well, again, scenario analysis. What are the scenarios? Scenario A is the person doesn't talk to me, doesn't give me the appreciation, but puts me, let's say, gives me 100% playtime, makes me an important person in the team, just doesn't say it. That's, I would say, one scenario. Another scenario is the person doesn't appreciate me and also shows that in giving me limited playtime. That is a scenario. And the third scenario, of course, is not appreciated and also absolutely not seeing not seeing the field, not playing, not being instrumental for the team, basically being marginalized. Those are the three scenarios. And under those three scenarios, now you're thinking, okay, what am I going to do? In the first scenario where I'm being appreciated and I play, I don't have a problem. In the second scenario, I think I can still say I don't have a problem because it's more of an ego thing. And let's just say I still work hard, I train, I get exposure to very high level training. All these things are in place. The only thing is my coach just doesn't give me the kind of appreciation that I think I deserve. This is an ego problem that can be solved by being a little bit more humble and working towards a solution where I can use my training and my skill set development to get to a better situation. And the third, of course, is the hardest one, where you're really in a hostile environment. And then, of course, the question is, should I run? What's my plan B? Or should I stay put, deal with it, suck it up, and still, of course, work towards a better situation? What's most important, I think, in anybody's career is always the skill set buildup. The skill set buildup is the functional skill set and also the mental skill set. So, for example, as an athlete, of course, you need to have functional skills. You need to continuously train and be exposed to high-level athletes so you can calibrate yourself and get better. And then you need, of course, as much sparring and real game experience as you can get. If you don't get it, you don't get it. So you can get the spar, meaning if the coach doesn't put you as a player, then maybe at least in the training you can get exposure. So those are the kinds of things. I think scenario analysis is very important. Scenario analysis is also takes away the anxiety, because anxiety is just the unknown of the future. And scenario analysis helps you understand, okay, what is going on? What are the scenarios? It's the same in the portfolio. When you have very high volatility and you're losing money mark to market, do a scenario analysis, think about, okay, what is the worst case? For example, we established that the worst case for Tesla is something around $600 a share. That will be down about 30% from where we are today. That will put us down for the year at about 55%. Actually, not that much, because no, it would be down maybe about 45%-ish, I'm guessing, and then add another 5 to maybe 10% to the biotech if we were in a really bad scenario. So let's say we're down 50% for the year. This is possible. It is still not going to blow our leverage. It will put us on the edge, of course, but it is a scenario that we can survive, a scenario that we wouldn't be shocked if it happens. We'd be very unhappy. But it's not worth losing our sleep, not losing our hair over this, because again, we are expecting the worst case scenario. This is scenario planning. Scenario planning in adversarial situations is there to take the anxiety out of the system. This is the key. So to summarize, when you're in a situation where you're working hard towards a goal and you're not being appreciated, or you're in a situation where for some reason your portfolio is in extreme volatility, do scenario analysis, figure out what are the scenarios, what's your worst case scenario, and then prepare to be ready to act when that assuming that worst case scenario might happen. Say, okay, if that happens, this is what I'm going to do. And then I think emotionally you're already in a much better place. Hopefully it doesn't happen, but you're taking away the anxiety and you have the strength to continue performing, and this is really what matters. Thank you.